Have you ever wondered how billionaires who earn millions each year sometimes end up paying a smaller percentage in taxes than the average worker? It almost sounds impossible, but it's true. In fact, there are cases where some of the wealthiest individuals pay effective tax rates lower than their assistants or drivers. And the surprising part is, they're not breaking any laws. They're simply playing by a different set of rules that most people don't even realize exist. In this video, we're going to pull back the curtain on the legal methods that allow the rich to reduce their taxes. No tricks, no scams, no loopholes in the shady sense, just an understanding of how the tax system works and how wealthier people are able to take advantage of it. By the end, you'll have a much clearer picture of why the rich often seem to pay less and how the system is designed in ways that favor people with assets over people with paychecks. Now, here's a question to think about. If a regular employee earns $50,000 a year and a wealthy investor earns that same amount in stock gains, should they be taxed the same? You might assume yes, but in reality, those two types of income can be taxed very differently. That's one of the first keys to understanding how the system works. Before we break down the biggest strategies, let's make something clear. This is not about encouraging anyone to dodge taxes or hide money. It's about education, understanding the difference between how money earned through work is treated versus money earned through assets, investments, or businesses. One of the first reasons the rich often pay less is something called capital gains. Capital gains are the profits people make when they sell investments like stocks, real estate, or even art. In the United States, for example, long-term capital gains are usually taxed at a lower rate than ordinary income. That means someone working a 9-to-5 job who earns wages may pay a higher tax percentage than someone who holds stocks for over a year and then cashes out millions in gains. This is a legal incentive built into the tax code to encourage investing, and the wealthy, of course, are the ones who benefit the most because they have more money to invest in the first place. But that's not the only reason. Another huge factor is how the rich structure their income. While most people rely on a paycheck, the wealthy often build businesses or hold assets that generate income in ways that can be deducted, deferred, or written off. For example, business owners can deduct expenses like office costs, travel, or even parts of their housing if they use it for business purposes. The more you can categorize spending as a business expense, the less taxable income you have left. Here's where it gets even more interesting. The wealthy often don't actually live by cashing out all their wealth. Instead, they borrow against their assets. Imagine owning stocks worth $100 million. Instead of selling them and paying taxes on the gains, a wealthy person could borrow, say, $10 million from a bank using those stocks as collateral. The bank is happy because the stocks are strong collateral, and the wealthy person now has $10 million in cash to spend without paying taxes on it, because technically it's a loan, not income. This strategy is sometimes called buy, borrow, die. Buy assets, borrow against them to live, and when they eventually pass away, those assets can transfer with favorable tax treatment. Now, you might be wondering, isn't that risky? What if the investments lose value? For everyday people, yes, it's risky. But for billionaires or wealthy families with diversified holdings, it's a manageable risk because their portfolios are designed to weather downturns. Another major strategy is real estate. The tax system gives huge incentives to property owners. Things like depreciation allow investors to deduct the theoretical wear and tear of a property, even if it's actually increasing in value. Add in mortgage interest deductions and other credits, and real estate becomes a tax playground. That's why so many wealthy individuals park money into real estate, Not only does it tend to grow in value over time, but it also shelters a lot of income from taxes. Let's pause and look at a famous example. Warren Buffett, one of the richest men in the world, has admitted openly that his secretary pays a higher tax rate than he does. Why? Because her income is wages, and his is largely capital gains, dividends, and investment income taxed at a lower rate. This isn't about him cheating the system. It's simply how the rules are structured. And that brings us to another big reason: charitable giving. When wealthy individuals donate to charities, they don't just feel good about helping causes, they also reduce their taxable income. Large charitable donations can create significant deductions. For ultra-wealthy families, this often goes hand in hand with creating private foundations. These foundations allow them to give money away, but often in ways that align with their long-term goals, values, or even legacy projects. Now, before we move on, let's loop back to that borrowing strategy. If the rich can borrow to avoid selling assets, how do they pay it all back? Many times, they don't. They maintain the loan as long as they can, and when they pass away, their heirs inherit the assets with what's called a stepped-up basis. That means the gains that built up over decades can essentially disappear for tax purposes when passed down, resetting the value for the next generation. It's one of the most powerful wealth transfer tools in the tax code. But what does all this mean for regular people? Should everyone start buying art or setting up foundations? Not necessarily. For most, the lesson is more about how the system favors ownership over labor. The more of your income that comes from assets, investments, or businesses, the more favorable the tax treatment usually is. Meanwhile, income from wages, the kind most people rely on, is taxed more directly and at higher rates. This leads to an uncomfortable truth. The system isn't designed equally for everyone. It's structured in ways that encourage certain behaviors, like investing, business building, and asset ownership. And while some criticize this as unfair, others argue it's what drives economic growth. But here's the surprising myth buster. Many assume the wealthy simply pay almost nothing in taxes. That's not always the case. In dollar terms, they often pay enormous amounts because their income is so high. But as a percentage of their income, especially compared to middle-class workers, the rate can be much lower. That's the part most people find shocking. So, the next time you hear about billionaires paying less in taxes than a teacher or firefighter, remember, it's not magic and it's not illegal. It's simply a result of how the tax system rewards assets differently than wages. And here's the final thought. Understanding how the rich legally reduce taxes isn't about copying them. It's about learning the principles. Even small steps like investing for the long term or understanding deductions can put you in a better financial position. Knowledge is the first step toward making smarter money decisions. If you enjoyed this breakdown and want more insights into how money, wealth, and power really work, subscribe for more insights like this.